You are listening to Keystone Stock Talk Podcast, episode 46. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook or via our 24-hour streaming radio station, pennystocks.fm. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. This week, due to the volume of questions for our Your Stock Our Take segment, we have picked two stocks to look at. PartnerJet Corporation, PJT, on the TSX Venture, and Namaste Technologies, symbol N, on the TSX Venture. For its part, PartnerJet is a full-service flight management and aircraft sales company capable of operating a wide range of corporate aircraft. A true microcap, the company has had a volatile year, trading as high as 40 cents to as low as just under 20 cents. It has taken a hit lately following weaker Q2 2018 financial results. Is it a buy, sell, or hold? We'll let you know. While Namaste brands itself as a Your Everything cannabis store, literally trademarking that beside the phrase, Namaste operates the largest global cannabis e-commerce platform with over 30 websites in 20-plus countries under various brands. Product offerings include vaporizers, glassware, accessories, CBD products, and the company will soon be selling medical cannabis in the Canadian market, subject to approval by Health Canada. Is it a buy, sell, or hold? We'll let you know. Our star of the week is GoEasy Limited, GSY, on the TSX, a full-service provider of goods and alternative financial services. The stock has gained around 10% in the past week. What is driving the surge? And is it an opportunity going forward? Now let's dig into the show. I welcome back my co-host, Keystone's Senior VP and Senior Analyst, Aaron Dunn. Welcome, Aaron.
Hello, Ryan. How are you today?
Very busy. Just got back in the office this week, was up in Whistler, had a great time up there, and now am back at it. And again, we're going to dig into two companies in our Your Stock Our Take this week, so it's kind of a bonus segment.
Absolutely, absolutely. Did you take a look at Facebook today?
I did notice this morning an incredible drop, 20% for a company of that size. It's shocking, definitely shocking to see a drop in a company and racing that much market cap all at once.
It was. I actually answered a question for a client on Facebook yesterday after they released their Q2 results. And the results actually at face value looked very good. The revenue, the earnings per share were up in strong double digits. But where the results disappointed was in the user growth, which fell below analyst estimates. And really, when it comes to these social media companies, that is what matters more than anything else, is you need to remain relevant in this competitive landscape. And if you're not growing your users at a reasonable clip, then or in line with market expectations, then the perception that you're giving investors is that perhaps other social media platforms are eating some of your market share, or just that you're not providing the excitement necessary to encourage users to join your platform.
Yeah, and Facebook has had privacy concerns. The Cambridge Analytica scare of late had some users saying they didn't want to use the platform. Perhaps that is actually affecting it, but it is all about adding more users, and management spoke to that in its conference call, and they talked about guiding lower on growth going forward. And when you're receiving relatively premium valuations, if you're guiding lower on growth, you can see what happens to the stock. It gets punished near term. Facebook may eventually recover. It is a behemoth in the social media field, and the company has a great balance sheet. And like Aaron said, the numbers really weren't that bad in the quarter, but it's all about going forward and adding more users. So there are some other names in the FANG arena of those stocks that we prefer over Facebook at this point.
And in fact, we're doing deep research on one of those FANG stocks right now, which could potentially be a recommendation in the near future.
Yeah, yeah. And of course, our thoughts go out to Mark Zuckerberg this week, who lost a tremendous amount of his personal fortune. But something tells me I think he'll be okay.
16 billion in one day, but unrealized.
Yeah.
I'm not shedding any tears for Mark.
No, I think he's not going to be destitute or on the street.
We won't be seeing him on the street anytime soon.
No, I think he'll be fine. And the company has had setbacks in the past and recovered. There are just some other names we prefer. And like Aaron alluded to, we're looking at one right now. So we've got that busy show. We've got 2 Your Stock Our Takes. The first one is going to be on Namaste Technology, symbol N on the TSX Venture. Again, it brands itself as your everything cannabis store, literally putting a trademark beside the phrase. I'm going to let Aaron take that one away. It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold.
Sure. Thank you, Ryan. Namaste Technologies. Right now, the company is trading at a price of about $1.35 per share. Full market value for the company of about $370 million. So about 270 million shares outstanding, which is a lot for a company this size. But what does the company do? Namaste Technologies operates a global cannabis e-commerce platform with over 30 websites found in over 20 countries under various brands. The company's product offering includes vaporizers, glassware, accessories, CBD products, and the company soon hopes to be selling medical cannabis in the Canadian market, subject to licensing by Health Canada. So the stock, like everything in the cannabis space, has been very volatile. It was up well above $3 per share earlier in the year. So it's lost over half of its value since then. Over single day jumps of 5 to 15% have not been abnormal, and the stock is down about 10% over the past week. But over the last few months, Namaste has been busy making various agreements and acquisitions. So far in July, the company has made an agreement with Indigenous Canadian medical dispensaries to provide consultations to the Indigenous community members. They also as well entered into agreement with a company called Blissco to provide technology platforms. The company acquired a company called Findify, which is has an AI and machine learning technology. They acquired this company on May 12th. They acquired this AI and machine learning technology, which they plan to use to essentially recommend cannabis strains to users through their website. So essentially, I would imagine you would tell their website who you are, what your profile is, what type of cannabis you're looking for, and they would match you with the right strains. So looking at the financials, revenue in their last quarter, which ended on May 31st, was $4.1 million. That was a 31% increase over the same quarter in the prior year. They did report a very big net loss of $8.1 million compared to a net loss of $3.3 million in the same quarter in 2017. So as per the company's MD&A, the increase in net revenues for the third quarter of 2018 was primarily due to our organic growth for the company. Great balance sheet. They've got about $44 million in cash, very little debt, so no issues there, but negative earnings. So you can't value this company on a price to earnings basis. They are seeing very strong growth in revenue, but their losses are growing faster than their revenues, and that's something that we are concerned about. Lots of growth potential here for sure, as with many types of companies in the cannabis space. I think that what they're essentially trying to do is they don't want to get into the production side of things. They want to be a pure play online distributor. That's essentially their brand. So we'll have to see how that works out for them. Definitely we see potential there, but there are going to be competitors in that space. And we always look for less at what companies are saying they're going to do and more at what companies are doing. So it's nice to see that this company is generating good revenues or decent revenues and good revenue growth. But relative to its market cap, the revenues are still quite tiny. $4 million in revenues in the quarter and a market cap of almost 400 million. So that puts the valuation to sales at an incredibly high level of well over 20 times on a trailing basis. Given the lack of profitability, we would consider the stock to be very speculative right now. We would not recommend it. This is something we will continue to watch as they ramp up revenues. But right now, it's high risk, highly speculative, and it's not something we would recommend for people to buy.
Yeah, I mean, it's a good summary. It just doesn't fit our fundamental profile in terms of revenue, cash flow, and earnings. Now, this sector is all waiting for essentially legalization, and this company is actively engaged with Health Canada in relation to their wholly owned subsidiary and the access to cannabis for medical purposes regulations, their ACMPR licensed producer. They're waiting medical cannabis, a unique license called a sales-only license, and they'll be one of the only companies, I believe, that has a sales-only license. They're looking for that, so that could be the next big piece of news that could come up for the company. And then going forward, they want to, we believe, brand themselves as a company that can sell cannabis, distribute cannabis online, electronically, and this would be a niche that they would occupy and potentially try to own that niche. It may be very difficult. But, to value this company, you have to make a ton of assumptions going forward in terms of growth. We're not comfortable doing that right now. If you want to speculate on it, that's up to you. It doesn't meet our fundamental criteria right now, like Aaron said. It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. So we're going to look at our next Your Stock, Our Take. That is PartnerJet Corp, PJT on the TSX Venture. This is a true microcap company. They traded around 29.5 cents. Their market cap is $2.7 million. That's a pittance. So what does the company do? PartnerJet carries on the business of a full-service flight management and aircraft sales company capable of operating a wide range of corporate aircraft. The company's revenue is generated through aircraft management contracts, charter and sub-charter activities, and aircraft maintenance contracts. The shares, after performing quite well, have taken a hit lately. Well, this is because the company came out with Q2 results. It saw a decrease in revenue of 11% to $3.7 million. But net income fell 46% to just under 80 million or 80,000 compared to 130,000 in the same period last year. Adjusted EBITDA fell 53% to 90,000 in the quarter from just under 200,000 in the same period last year. So let's look at the valuations. That's how we look at a business. Its trailing valuations are actually low. The company has a PE or price to earnings over the last 12 months of about 5.6. And its price to EBITDA is 3.9, 3.8 in that range. If the company can grow, these are very low multiples. However, as we saw in the last quarter, it was not growing. The balance sheet is very healthy and net cash position, little to no debt. Our take on this, though, PartnerJet has seen falling revenues and earnings over the last year. While it has a healthy and highly liquid balance sheet, the company doesn't describe any specific plans going forward in their MD&A and is making only general statements in terms of marketing and expansion. So there is no real outlook for growth on this company right now or concrete plan that we see in place that they are conveying to the public markets. We also note that the company has done over $2.5 million in related party transactions or business with members of the board of directors, shareholders, and enterprises which are controlled by these individuals. We see that in their financial statements. Now, there's nothing inherently wrong with a related party transaction, but they do raise the specter of conflicts of interest. So this is something to watch. And that was just over the first 6 months of this year. The volatility of stock with no sign of settling has no sign of settling in the near-term future. Combine this with declining revenues and earnings raises red flags as far as fitting into our investment criteria. We would not buy PartnerJet at this stage. It doesn't make our criteria.
And just to add to your comment about the related party transactions, I think you said 2.3 million, Ryan. Well,
2.5 in that range.
2.5. Okay. Well, the entire market value of the company is worth 2.5 million. So if you're talking about 2.5 million in related transactions and $100 million company or a $300 million company, yes, it's not as relevant. But when you're talking about a $2.6 million company, that becomes very relevant. And with these microcaps, as we've seen many times in the past, if they start disappointing the market, the growth slows down, the resulting decline in the share price can be very swift and very extreme. And the best way to really judge a company's product offering is to see how well it's being accepted by its customers. So the fact that revenues and profitability has declined for the company is definitely not a good sign. Doesn't mean they can't turn it around, but from our perspective, we would never just assume that that's going to happen. We would actually need to see the progress on paper.
Yeah, and PartnerJet, for its part, is doing some good things. They're earnings positive. The company has a solid balance sheet. But one thing I would say to management is communicating better to the market would allow analysts to look at the company better and see the plan going forward in terms of having some guidance there, even basic guidance, would give the market some kind of satisfaction on, if you have a poor quarter, but, you're looking 2 to 5 years out to grow 25 or 50% or whatever your targets are, communicate those with the market. It can help an analyst value the company. Now, our weekly star, we're going to move to that. It's goeasy Limited, GSY on the TSX. Aaron, take it away. From our Stars and Dogs segment, it's time for this week's Star.
Thank you. goeasy, trading at a price of about $43, market capitalization of $600 million. The stock has had a nice little pop over the last few weeks and is up 16% over the last 3 months, 50% over the past year. What does the company do? Well, goeasy is a finance company. It has 2 segments to its business. Easy Home, which offers lease-to-own services for household items like furniture, appliances, and electronics, and Easy Financial, which provides subprime consumer loans to customers. What's been driving the stock? Well, the company issued preliminary Q2 results on July 12th, which drove a nice uptick in the share price. The results were very strong. Gross consumer loans increased 61% to $687 million. Quarterly loan book growth was a record at $85 million, up 120% from the same quarter last year. And charge-offs for bad loans also declined to 12.4% of the portfolio on an annualized basis, compared to 14.7% a year ago. The full results aren't out until August 8th. We would expect a continuation of the very strong growth in revenue and earnings per share. In 2017, the revenue growth was nearly 20% and earnings per share were up 36%. This has been the general trend for the company over the past year, which has driven that 50% increase in the share price over 12 months. Looking at the company, the real driving force behind goeasy is its Easy Financial business. It's about 70% of revenues for the company right now. Once again, this business is focused on consumer loans to the non-prime or subprime customer segment. So the company is growing this segment very aggressively. The business is performing great right now. Management is executing the business model very well. Our concern is the inherent risk in the business model. This isn't the type of company that we would expect to have a lot of resilience in the event of deteriorating economic conditions. So subprime loans generally, well, what that means is you're making loans to risky borrowers. Just to give you an example, the company charges an interest rate annually which averages about 43%. So these are generally small loans. I believe the average is about $5,000 to $10,000 per loan, but very risky when you're thinking a 43% interest rate. What type of borrower is willing to pay that rate? That said, for now the growth profile is intact. Management owns a significant stake in the company. It's trading at a valuation relative to earnings of about 15 times. For a higher risk stock, we think that goeasy does have some solid fundamentals underpinning its business. It's not a company that we're recommending right now, but it certainly has been executing well. And as long as the economic environment remains reasonably healthy, we believe that will continue to be the case.
Yeah, and the gains that we've seen over the past year and even in the past couple of weeks make it our star of the week. But of course, as you pointed out, this company, when the wind is at its back in terms of positive economic growth in the economy generally, it is a stock to potentially own. If you start to see cracks in that, it may be a company to move to the sidelines on. but it's certainly executing well right now. That about does it for this week. That's a wrap on our show. I'd like to thank our listeners for listening. Thank Aaron for co-hosting with me. And again, encourage all our listeners to go on to iTunes, rate us, review us, like us on Facebook. Keep sending in your questions to our Your Stock, Our Take segment. Either email them, send them on Facebook, hit us on Twitter, any of the usual social media buttons out there. Keep your questions coming in. We're getting more and more of them, which is great. And again, profitable investing.
Profitable investing.